Good morning, ladies and gentlemen. Today, my group will analyze the financial performance of Company 1, Supagro, and Company 2, Etronic during the period 2024 to 2025 to evaluate which company may represent the stronger investment option for Valerina. So my session focused on profitability analysis. The first slide will compare the profitability performance of two companies using four key profitability ratios. The first one is return on equity, or ROE. It measures the return generated for shareholders from their investment in the company. You can see from the table that although both companies decline, Company 1 maintains significantly higher compared with Company 2. So this indicates that Company 1 continues to generate stronger shareholder returns overall. The second one is return on assets. It measures how efficiently a company uses assets to generate profits. So Company 2 improved from 9.42% to 9.91%, while Company 1 slightly declined. So this suggests that Company 2 is utilizing its assets more efficiently. And in addition, we can see that Company 2 also improved in both gross profit margin and net profit margin, whereas Company 1 declined across most profitability ratios. So the next slide will talk about the comments and the reason behind this result. Company 1 operates within the supermarket industry, which is highly competitive and affected by rising operating costs, inflation, and wage pressures. This factor may have contributed to weaker profitability trends. However, the company still demonstrates relatively strong shareholder returns and greater business stability. But in contrast, Company 2 appears to be benefiting from continued demand for electronics and work-from-home products. The improvement in profitability ratios may also reflect stronger operational efficiency and revenue growth from expanding operations across Australia and New Zealand. So based on that profitability analysis, I would recommend Company 2 because in general, while Company 1 offers greater stability and stronger shareholder returns, Company 2 demonstrates stronger profitability growth and operational performance, making it like the more attractive long-term investment options from a profitability perspective. So now let's move to the Jacob section, which is about asset efficiency.
Asset turnover ratio it measures how effectively a company uses its total assets to generate sales and how productive the company's assets are. A higher figure means the company is generating more revenue per dollar of assets. When we're looking at Supagro, their asset turnover in 2024 was 2.15 and it went up to 2.18 in 2025. And Etronics, their 2024 figure was 2.77 and their 2025 figure was 2.81. Inventory turnover ratio, it measures how many times a company sells its inventory and replaces it within a year. A higher ratio means the company is selling quickly and the stock is not sitting on shelves. A low ratio suggests slow moving or excess stock. The 2024 figure for Company 1 was 12.83 and this went down in 2025, slight decrease to 12.59. Company 2, Etronics, their inventory turnover was 6.15 and it actually increased to 6.25 in 2025, showing a slight increase. The amount of days it takes for them to do their inventory, for Company 1 it was 28.45 days in 2024 and that went up to 28.99 days in 2025, so that's showing an increase. For Company 2 it was 59.34 and it went down to 58.4 in 2025, showing a lower figure. Moving on to the debtors ratio, this measures how many times a company collects its accounts receivable in a year. A higher ratio means the company is collecting money more frequently from its customers. It highlights how effectively the company's credit and collection policies are. When we're looking at Supagro for 2024, in times, their debtors turnover was 104.05 and this decreased down to 88.82 in 2025. Etronics, theirs was 125.76 and that decreased as well to 117.86. The days debtors was 3.31 for Company 1 in 2024 and it increased to 3.94 in 2025. For Company 2 it was 2.9 and this increased as well to 3.09. The times creditor ratio measures how many times a company pays its suppliers in a year. A lower ratio means the company is taking longer to pay its suppliers, can indicate how well a company manages its cash outflows. For 2024, Company 1's creditor turnover was 9.73 and this decreased to 9.25 in 2025. Company 2, Their creditor turnover was 9.26, and this increased to 9.66 in the 2025. Moving on to days creditors. Days creditors measures how many days on average it takes the company to pay its suppliers. A higher number means the company is holding on to cash longer before paying. Too high may damage supplier relationships. For Company 1, in 2024, it was 37.51, and this increased to 39.46 in 2025. For Company 2, Etronics, their days creditors was 39.41, and this decreased to 37.78 in 2025. Etronics, Company 2, demonstrates stronger asset efficiency overall, generating more revenue per dollar of assets with a higher asset turnover ratio, 2.81 in 2025 versus 2.18. While Supergrow has a higher inventory turnover, this is driven by the nature of the grocery industry rather than being a superior business, making it a less meaningful advantage. Both companies collect debts in under 4 days. However, Etronics collects slightly faster, indicating stronger credit management. From an asset efficiency perspective, Etronics is the stronger investment candidate as it has improved across multiple ratios from 2024 to 2025.
So after we seen how this company is making a profit, so now I'm going to walk you through to look at the safetyness of the business, which is liquidity, because even the profitable company, they can fail if they run out of cash to pay its short-term debt. So I have compared the data from 2024 and 2025 for both companies to see which company is the best investment for our client. First, let's have a look at the Company 1, Supergo. Their current situation is kind of weak because for the last 2 years, their current ratio have just stayed around 2.59. This means that every $1 they own, they only have 59 cents to pay it back. More importantly, let's look at their quick ratio, which only grew from 0.17 to 0.19. This is a red flag because it tells us that the business is heavily relying on their inventory to selling to get a cash. So if the sale is slowed down or the supply chain is break, this means the company is in a big trouble to find a quick asset to pay its debt. Now let's have a look at the Company 2. This company is showing a much stronger positions and the positive trends because over the past 2 years, their current ratio have improved from 1.32 to 1.38, which means they have a safetyness of extra access to pay their short-term debt. So, and also the quick ratio is also improved from 0.30 to 0.38. While they're still managing their inventory, but this company is much more better than the Company 1. So this upward trend have showing that this business have managing their debt with more discipline. My final recommendation for our client is that she should invest in the Company 2. Even though the Company 1 share is much cheaper, which means she can buy a lot of share of this company, but we must not overlook the quality over the quantity, because if she buy the share of the high-risk company, it just means she buying more the program. So the data show that the Company 2 is much a better choice and the trend is moving in a right direction, and there is a much lower risk of losing a client money.
Our capital structure analysis today is looking at how much debt and equity a business uses to finance itself. Our debts to asset ratio is measuring how many dollars of liabilities a business has for every dollar of their assets. A ratio above 50% suggests that the business relies more heavily on debt relative to its assets. Equity ratio is showing us how much of the company's assets are funded per dollar of equity, and our debts to equity ratio shows us how much debt a business uses compared to the owner's money. Here, the interest coverage ratio is measuring how many times a company's earnings can cover interest expenses. A value above 3 is usually acceptable. Our cash flow output to debt ratio is telling us that by comparing a business's cash flow to its total debts, it's showing us whether they can or cannot meet the required payments. Both companies have been able to reduce their debts to assets ratio, indicating improved financial stability and less reliance on debt. However, Supergrow remains more dependent on liabilities to finance its assets rather than Etronics. This is showing us that Supergrow has a higher financial risk due to the heavier reliance on debt, while Etronics is just in a stronger financial position. Although both ratios are above 50%, Etronics is closer to that healthier ratio between debts to their assets. Both businesses are increasing their equity ratios, showing improvement in financial stability and a greater reliance on equity rather than debt. However, Etronics has a much higher equity ratio compared to Supergrow, meaning that they are in a stronger financial position and less dependent on debt financing. Both businesses have been able to reduce their debts to equity ratios, showing active improvement in financial stability and reduced reliance on debt financing. However, Etronics has a lower ratio than Supergrow, meaning that they are in a stronger financial position and are less dependent on debt. In contrast, Supergrow is at a significantly greater financial risk due to how heavily they rely on borrowed funds compared to owner's equity. Etronics has a much higher interest coverage ratio, indicating that it's in a significantly stronger financial position with a much greater buffer to cover their interest payments, while Supergrow has lower coverage, which is actively decreasing and therefore at a relatively higher financial risk, even though it is above the acceptable level of 3. Both businesses have shown slight improvement in their CFO to debt ratios, meaning that they are generating more operating cash flow relative to their debt. However, Etronics has a slightly higher overall ratio, indicating that it's in a better position to repay its debts using cash from operations. Despite this, both companies still have relatively low ratios, meaning that neither generates enough operating flow to comfortably cover all of their debt obligations. Overall, Etronics would be the better investment because it shows lower reliance on debt, stronger equity levels, higher interest coverage, and a better ability to repay its debts using those operating cash flow funds. This is telling us that it's in a more stable financial position and carries lower financial risk compared to Supergrow, meaning which remains highly vulnerable to debt and risks. Thank you.
Thanks, Georgia, for the capital structure analysis. I will now provide the final investment recommendation. So in conclusion, although Company 1 offers greater business stability and stronger inventory performance, Company 2 shows stronger profitability growth, a better liquidity position, more efficient asset utilization, and a stronger capital structure with lower financial risk. Also, continued demand for electronics and work-from-home products may further support future growth potential. Therefore, based on the overall ratio analysis, we would recommend Company 2 as the more attractive long-term investment options for Valerina $10,000 investment. So that is all of our presentation. Thank you for listening.